Can the PE ratio be a trading opportunity? The PE ratio is the most popular stock indicator for evaluating stocks. But how meaningful is it really? And is there a chance here to profit from the mistakes of others in the stock market? The others are often the majority of investors. I'll reveal it to you in this video. Do you know why so many people fail in the stock market? Because investors do the same as the majority does. But the stock market can only work if the majority is usually wrong. Otherwise, anyone could get rich without effort. If you don't make the same mistakes as the majority, you won't fail in any financial market. If you bet against the majority, you can even be very successful. I show you on this channel what the majority gets wrong. I show you how to prevent yourself from being part of that and how to take advantage of others' mistakes. But important, this channel is not investment advice. I don't have a crystal ball that tells me what the right investment will be in the future. Foolproof tips only come from scammers. Subscribe to this channel and activate the notification bell. If an opportunity arises in the stock market to bet against others, I will publish ad hoc videos you won't want to miss. Let's go back to the PE ratio. What exactly is the PE ratio? The abbreviation stands for price per earnings ratio. The figure is calculated, as the name suggests, from the profit and the price of a stock. The annual profit of a company divided by the number of shares issued gives the earnings per share. It's that simple. Earnings per share say nothing definitive because the number of shares issued can be arbitrarily set by any company. The price of a stock may indicate a trend when compared to the past, but it does not assess the company's value. Because here, the number of shares issued is again important, which each company can determine. This is a common mistake made by many investors that stock corporations often exploit. High stock prices look expensive, low prices seem cheap. Therefore, companies with strong stock prices issue free shares to make the stock appear inexpensive. In the so-called stock split, for example, the number of shares issued is doubled, which halves the stock price. The historical prices in the charts are adjusted for stock splits, so you do not see how many times a stock has been split. The fact that stocks often continue to rise after a split is a result of the mistakes of others. If you buy just before a split, you can profit in the short term from investors buying who consider the price to be cheap. But what does the PE ratio now indicate? The current price divided by the earnings per share gives the PE ratio. The earnings for the current year and the following years are estimated. But remember, no one can predict future earnings. If earnings are unpredictable, the PE ratio can never reliably show whether a company is undervalued or overvalued. But many investors believe otherwise. When you look at the PE ratio of an index like the S&P 500, just Google it. You have a benchmark for a normal value since it summarizes the PE ratios of all the stocks in the index. Misestimations in individual stocks are thus smoothed out. This figure often hovers around 15. Therefore, stocks with a PE ratio of 5 or 6 are considered undervalued and therefore cheap, while stocks with a PE ratio of 50 or 100 are considered too expensive. Many investors buy the stock because of its low PE ratio. However, the PE ratio is usually low because the stock price has been in a long negative trend and has fallen sharply. The PE ratio can theoretically also be low because earnings forecasts have been raised and the price has not increased. But the stock market loves companies that unexpectedly increase their profits. Therefore, prices will immediately rise, and the PE ratio will become more expensive. A price-to-earnings ratio of 5 looks lucrative, but it is on the verge of turning negative. Once a former earnings forecast turns into an earnings warning, a euphemism for a loss announcement, it can become negative. Then, no one will want to buy the stock because of the PE ratio. When do you use the PE ratio to bet against others? When there is a general market crash, all stocks usually fall. The tide lifts all boats, but if you are betting against others, you should keep an eye on the ebb. During an ebb, PE ratios can fall to levels where stocks are cheap, yet no one buys out of fear. Look for stocks that have fallen despite not suffering from the cause of the market crash. Very often, these are stocks that are not dependent on people's consumption behavior. For example, utility companies, sometimes banks, and everything related to health. The services and products of these companies are also needed during a crisis, making a profit decline less likely here. So look for stocks that are not popular, yet are rising and have a low PE ratio. Stocks that have had a poor price history and have been steadily rising for at least a year are often affected. Most people will ignore these stocks for a long time. This is your chance. If the stock price rises and the PE ratio remains low, the earnings forecast will likely be raised, which will lead to further price increases. This is a potential buying opportunity. Do not ignore the trend. Instead, use it. If the PE ratio is low because the stock price has fallen without a general market crash, do not buy the stock. It is too risky. If the PE ratio is low, even though the stock price is rising, it could be a buying opportunity. Finally, the question remains, what if the PE ratio is very high? Think about the mathematics behind the formula. A price-to-earnings ratio of 30 can suddenly turn into 15 if the projected earnings double. Especially young companies have the potential for their earnings to triple or quintuple. Then, even a PE of 100 may not be exaggerated. If you believe in these earnings increases, you can buy. If you think the expectations are exaggerated, stay away. How do you use the PE ratio for your analysis? Write it in the comments. I look forward to differing opinions.